Here's something that might keep you up tonight. That money sitting in your bank account right now, most of it isn't actually there. The bank took it, lent it to someone else, and that someone else put it in their bank, and then that bank lent it out again. Your $100 might be getting used by 5 different people at this exact moment. And the wildest part? This isn't some scandal. This isn't fraud. This is literally how every bank in America has operated for over a century. It's called fractional reserve banking, and once you understand it, you'll never look at your bank the same way again. Let me walk you through this, because when I finally understood how this worked, I was genuinely annoyed that nobody had explained it to me sooner. So let's start with what most people think happens when you deposit money. You walk into a bank, hand them $1,000, and in your mind, there's now a little pile of your cash sitting in a vault somewhere with your name on it. Maybe they put it in a safety deposit box. Maybe there's a nice little digital tag that says, "This belongs to Sarah." Yeah, that's not what happens. Not even close. The moment your money hits that account, the bank is already making plans for it. They're legally allowed to take most of your deposit and lend it to someone else. We're not talking about a small percentage here. Banks typically keep only about 10% of deposits on hand, sometimes less. So your $1,000? The bank might keep $100 in reserve and immediately lend out $900 to someone buying a car or starting a business or consolidating their credit card debt. Now here's where it gets interesting. That person who borrowed the $900 doesn't stuff it under their mattress. They spend it or deposit it somewhere. Let's say they deposit it at another bank. That second bank now has $900 in new deposits. And what does that bank do? They keep 10%. That's $90, and lend out the remaining $810. And that $810 gets deposited somewhere else. And that bank keeps 10% and lends out the rest. See where this is going? Your original $1,000 didn't just stay $1,000. Through this cycle of deposit, lend, your money multiplied. Economists call this the money multiplier effect. Your single $1,000 deposit can theoretically create up to $10,000 circulating in the economy. Now, I know what you're thinking. Wait, if the bank only has 10% of my money, what happens if I want to withdraw it all? Great question. And this is where it gets a little uncomfortable. If you walk into your bank tomorrow and ask to withdraw $1,000, you'll get it. No problem. Banks keep enough cash on hand to handle normal day-to-day withdrawals. But here's the thing. They're betting that not everyone will want their money at the same time. If every single customer showed up tomorrow demanding their full balance in cash, the bank couldn't pay. They literally don't have it. This is called a bank run, and it's every banker's nightmare. It's also why the Great Depression got so bad in the 1930s. People panicked, everyone rushed to withdraw their money, banks collapsed, and people lost everything. This is exactly why the FDIC exists. After that disaster, the government created the Federal Deposit Insurance Corporation. They basically said, look, if your bank fails, we'll cover you up to $250,000 per depositor, per bank. It's insurance for your deposits. This stopped the panic because people knew their money was protected even if the bank went under. But let's get back to how the bank actually makes money from all this, because this is the part that really matters for your wallet. The bank pays you interest on your savings account. Right now, if you're lucky, maybe you're getting around 4% at a high-yield savings account. Many people are still getting less than 1% at their regular bank. Meanwhile, the bank takes your money, lends it out, and charges the borrower way more. A car loan might be 7%. A personal loan might be 10 or 12%. A credit card? 20, 25, sometimes even 30%. That gap between what they pay you and what they charge borrowers is called the spread. And that spread is where banks make billions of dollars every single year. Let me make this concrete. Say you deposit $10,000 in a savings account earning 4% interest. Over a year, the bank pays you $400. Not bad. But the bank takes $9,000 of that deposit and lends it out at 10% for a personal loan. Over that same year, they collect $900 in interest from the borrower. They paid you $400 and made $900. That's a $500 profit just from your deposit. And remember, this happens at scale, with millions of customers and billions of dollars. Now multiply this across all the services banks offer. They charge fees for overdrafts. They charge fees for wire transfers, They charge fees for using ATMs outside their network. Some banks even charge monthly maintenance fees just for having an account. In 2022, American banks collected almost $8 billion in overdraft fees alone. Your money isn't just sitting in an account. It's an employee working for the bank, generating profit around the clock while you get a tiny percentage of the returns. And here's something that took me way too long to realize. When interest rates go up, like they have over the past couple of years, banks make even more money. They immediately raise the rates they charge on loans and credit cards. But those savings account rates? Those go up much more slowly, if they go up at all. Banks drag their feet on passing higher rates to depositors because every month of delay is more profit for them. Now, I'm not saying banks are evil. The fractional reserve system actually does important things for the economy. It creates credit, which lets people buy homes, start businesses, and invest in their futures. Without this system, there would be way less money available to borrow, and it would be way more expensive. But here's the thing you need to understand. Banks are businesses, very profitable businesses, and they've designed the system to benefit themselves first. The relationship is not equal. They need your deposits to operate, but they've set things up so you get the smallest possible cut of the profits your money generates. So, what do you actually do with this information? First, stop leaving large amounts of money in accounts that pay almost nothing. If your checking account is paying 0.01% interest and you've got $15,000 sitting there, you're basically giving the bank free inventory to profit from. Keep what you need for monthly expenses in checking and move the rest somewhere that actually pays you. Second, shop around for better rates. Online banks and credit unions often pay significantly more than traditional big banks because they have lower overhead costs. We're talking 3, 4, sometimes even 5% on savings accounts versus the pathetic 0.5% many big banks offer. That difference adds up to real money over time. Third, understand that when you take on debt, you're now on the other side of this equation. You become the profit source. That credit card balance at 22% interest? The bank loves that. Every month you carry a balance, you're paying them to use money that might have started as someone else's modest deposit. Pay off high-interest debt as fast as you possibly can, because that interest compounds against you just as aggressively as it compounds for them. Fourth, consider credit unions. They're nonprofit, which means they're owned by their members, not shareholders. They still use fractional reserve banking, but the profits go back to members through better rates, lower fees, and better loan terms. It's not a perfect solution, but the incentives are more aligned with your interests. Look, I'm not saying to stuff your money in your mattress. That would be ridiculous. Banks provide real security and convenience, and your deposits are insured up to that $250,000 limit. But understanding how this system works changes how you think about where you keep your money and who's really benefiting from it. Your $100 isn't just $100. It's seed capital for a system designed to multiply money, mostly for the bank's benefit. The least you can do is make sure you're getting a fair cut. If this made something click for you, or if you're finally starting to see how these money systems actually work, consider subscribing to Like Your 5. We break down financial concepts like this every week. No jargon, no judgment, just clear explanations so you can make smarter decisions with your money. Hit subscribe, and I'll see you in the next one.